Hello, everybody. Welcome to Wednesday. The S&P 500 was up a grand total of 0.03% today. Actually, you're probably going to see some fairly moderate motion in the market until the jobs report comes out on Friday. That's kind of a big deal. But one of the things I'll bring up is kind of fascinating. I read an article today on CNBC's website talking about seasonality. If you go back to 1945, guess which month has the lowest rate of return on average since 1945? And I think it's an interesting quiz because a lot of people say October because we've had some big downturns in October historically and what have you, but it doesn't even make the top three. The very worst month on average since 1945 was September, which is what we're in now as of today. And it was down a grand total of 0.56% on average. So kind of interesting. The next lowest month was February, down 0.15%. And then the third lowest month was August, which we just came through, which is actually up 0.03%. So you can actually tell for the most part that the market does go up more than down. That's why we all invest in that too. But one of the things that's interesting when you dig into the data, if you look at the last, say, 4 Septembers, three of them were up, fairly substantially. Last September was down. Last September and October, we had kind of down months both times, I think partly because we were heading into the election and there was some uncertainty about what was going to happen there. So very fascinating. I don't think that the seasonality works as a measure of, when you should move and those types of things, partly because so many people know about it and it tends to shift and what have you. It's not a good trading mechanism. I do try to point out those things that I think the market really looks at and that are very important. And we spend an awful lot of time talking about the Federal Reserve, and that is because that is one of the things that's so important. And so this week, it is important because of the jobs numbers that are coming out. And this particular Federal Reserve at this time is looking at jobs very, very closely because they're trying to figure out when to cut back on buying bonds and trying to figure out, when to start raising interest rates again. And so I think we'll see the market kind of sitting sideways here through Friday and see what happens. I wouldn't be surprised if it doesn't come out a little bit soft, only because last month was very good and jobs kind of lag. It takes time for companies to, put out a posting and do interviews and then finally hire somebody. And so the number we're going to get for Friday is how many people were hired in the month of August, and probably has to do with job postings and what have you that happened in July and in June and such too. And so those are going to maybe be more impacted by what's happening with the Delta variant than the numbers that we got last month. We'll see what happens. But there are lots of jobs open, but the jobs that were lost were predominantly in businesses where the virus was an issue. So as that virus starts to peak back up, we might see some things. But what we are heading into is a very, very interesting jobs period here. As people, kids get back to school and the scenario with the extra unemployment benefit starts to drop off, what will happen? And so I have read articles saying that the Fed's really, really more interested in the jobs numbers coming out of September and that they'll probably make more concrete determinations on what they want to do really in November, because it takes some time for them to get all those numbers together. But this is important. This will be every one of these jobs reports that comes out is pretty important right now. So very interesting time frame, of course. Good to see the market go up a little bit. We saw more motion today really in the NASDAQ type stocks, the growth type stocks as a whole than we did in the S&P 500. But still, I think we're going to see some sideways motion for the most part, and I wouldn't worry about that. A soft jobs report wouldn't be a bad thing either, only because of the fact that, it takes some of the heat off of the possible inflationary pressure that might be out there too. So better to see more jobs created, definitely, in my opinion. But you get too many jobs created and it really scares the market about inflationary pressure. So anyway, that's what's happening right now. Look forward to talking to you tomorrow. Thank you very much.